So Europe finds itself in this very difficult situation where, as you can see from this chart, we have a situation of policy paralysis to some extent, where the crisis was driven by a lack of confidence on the part of investors in the capacity of policymakers to manage and contain the crisis. You had disagreements between member states as to how to manage the crisis, leading to a conflicted piecemeal policy response. This in turn fueled doubts about the cohesion of the euro area, doubts about whether Greece would stay in the euro area. And this in turn led to a driving up of borrowing costs, a sort of a centrifugal dynamic that led to further disagreements about how to handle the rising cost of the crisis. And really, what we had then is the ECB stepping in, and trying to put in place circuit breakers to break this dynamic negative feedback loop that was really driving the euro area deeper and deeper into crisis by driving up the borrowing costs of governments, by drying up the financing that was being received by the banking system. And this is both the outright market transactions, a commitment to buy bonds, and also, of course, the long-term refinancing operation. So where are we in Europe now? The situation is the crisis is being contained primarily by the actions of the European Central Bank, and adjustment is occurring in Europe. And what you see here is a chart showing you that labor costs have started to fall substantially in Ireland and now have turned down in Greece, Italy, Spain, and Portugal. And this is really an essential part of the adjustment process, because what happened during the boom years of Europe is that labor costs rose very rapidly in the European periphery. And these countries have to reestablish an economic base that is sustainable when you don't have an economy being fueled by a continued rapid growth of credit. And adjustment is occurring, but this adjustment is costly and is going to take a long time. And you can see this here with the unemployment rates that are being required to bring about this adjustment in wages. And what you are witnessing here is the high cost of being in a currency zone, where if you share a common currency, you, the countries in crisis, cannot depreciate your currency as a way of really improving competitiveness. And so it has to happen through this long, painful process. And this is a cost of having a common currency, which perhaps was not appreciated when the countries joined the euro area. And of course, this adjustment process is also happening in the banking system. And you can see it already in this chart as a contraction in credit in the periphery countries, matched by a stabilization in credit in the core countries of Germany, France, the Netherlands, which is really part of an adjustment of the banking system to the much tighter liquidity and funding conditions and the credit costs that come about from the problem assets that these banks have to recognize and manage down on their balance sheets. So really, what is going on here in the euro area is a deleveraging of the banking system. And this is what has implications for Asia. And you can see in this chart 3 scenarios for how euro area banks are going to deleverage. These scenarios are outlined in the Global Financial Stability Report, which I'm not going to spend much time on them because I really want to talk mostly about Asia. But just so you can see what's involved here, much of the reduction in assets, in the size of these banks, occurs through asset sales. Okay, but there's also a credit contraction that occurs as well. And this is really where the macroeconomic costs of the adjustment come from, where banks cut credit. And in particular, banks are cutting credit in the rest of the world. That is, these banks are under pressure, both from the regulators, both from the management, to bring resources back to their core activities. And often this means cutting back in activities in other parts of the world where they don't have a fundamental competitive advantage. And in particular, in Asia, the banking model that many of these European banks relied on was one where they used wholesale funding or funding from their parent companies to finance banking activity in Asia because they lacked a natural deposit base in the Asian region. And so the consequence of the European crisis for Asia is a large-scale deleveraging in Asia. And I think that's what we're seeing with this chart, which shows you the most recent data from the Bank for International Settlements of European bank lending in Asia. And what we see here is that there was a large-scale contraction of euro area bank lending during the peak of the funding pressure in the second half of 2011 that basically stabilized after the ECB did its emergency funding operations at the end of 2011 and in early 2012. So you had some bounce back of lending. But in countries like France, for example, they cut their lending activities in Asia by 40% in just half a year. And so what you see then is a very sharp cutback by European banks in the Asian region, offset to some extent by increased lending by Asian banks from Japan, Taiwan, Australia, and by other. And the other is primarily Hong Kong and Singapore banks. And so what you see then is a rapid substitution in lending by Asian banks for the European banks as the European banks deleverage. And this substitution is driven by a radical transformation of the funding environment for European banks, both because it became much, much more difficult for these banks to fund in private wholesale markets, and also because of regulatory pressures where the regulators were demanding that banks really manage their liquidity much, much more carefully. And this meant contracting credit in areas where they could contract credit, which often was in assets and in short-term lending in the Asian region. So let's take a look now at some of this transformation of Asian credit. And you can see here in this first chart, a chart showing lending by Asian banks in Asia. And this is lending from that's syndicated lending, right? Which is really the only data that we have available to look at Asian bank lending in Asia. And this includes large-scale trade finance, supply chain finance, general corporate syndicated lending, aircraft leasing, project finance, shipping, infrastructure, investment, all forms of credit that are done in dollars. And this comes back to the point that I made at the beginning of my presentation. While Asia has large banks, most of the international cross-border lending connected to trade and project finance is done in dollars in Asia. And Asian banks are stepping in, and they are providing this dollar funding. But to provide this dollar funding, Asian banks have to raise dollars because, like the European banks, Asian banks, with a few exceptions in Hong Kong, generally lack a natural dollar funding base. Right? So HSBC has substantial dollar deposits here in Hong Kong because Hong Kong is a global corporate and treasury management center for Asia, and a lot of multinationals will put funding, hold deposits here. But for many other Asian banks, they are raising their dollars in the international money markets. And this includes the Japanese banks and many other Asian banks, which is why I have charted the dollar funding received by Asian banks as the blue line here. And what you can see is a correlation between dollar funding received by Asian banks and dollar lending by Asian banks in Asia, just to really highlight the sensitivity that Asian banks also have to the availability of dollar funding. Now, this isn't true for all Asian banks. In particular, if you look at Japanese banks here, Japanese banks have been by far the most aggressive new lenders in Asia. They have been expanding their syndicated lending, their trade finance, their project finance in Asia very aggressively because they have very large balance sheets, and they have a lot of liquidity. They have really a market that's structurally low profit in Japan, and therefore an incentive to expand in Asia, and very good access to dollar funding globally. So you can see in particular that the Asian banks have been much less sensitive to fluctuations in their dollar funding, and their dollar funding has been more stable than the dollar funding received by some of the other Asian banks, right? And you can do this sort of analysis down to the country level. But the basic story is that Asia is expanding in areas, Asian banks are expanding in areas where they are more reliant on dollar funding. And this is especially true in the area of long-term funding, project finance, shipping, aircraft leasing. These are all areas of finance where Asian banks are particularly strong because of the importance of shipping, the importance of infrastructure investment in Asia. And you can see very clearly in this chart how Asian banks have expanded their activities and really displaced European banks as the primary suppliers of long-term dollar financing, not only in Asia, but globally, because this chart shows global long-term syndicated finance.